Okay, so today we're unpacking what I think is a wildly fascinating earnings report from Polaris Renewable Energy. This is for the second quarter ending June 30th, 2026. Now, if you've been following the renewable sector, you already know Polaris operates all across Latin America and the Caribbean. But honestly, at first glance, this quarter's numbers kind of left me scratching my head. That is until I read between the lines. We're going to see exactly how backward-looking performance really only tells half the story here, and how shifting our context reveals this massive future that's literally being built right in front of us.
Which brings us to the big question for this explainer: how exactly does a renewable energy company turn a dip in quarterly production into a roadmap for massive multi-decade growth? I mean, usually a production dip is a major red flag, right? Cause for concern. But as you'll see, the surface numbers are actually hiding an incredible strategic leap forward.
Okay, let's dive into this. First, we need to look at the raw financial and operational numbers from the Q2 2026 report. I'm just going to fire through these top-line metrics real quick so we have our baseline established. First up, 199,130 megawatt hours. That is the total consolidated energy production Polaris generated across its entire portfolio for the 3-month period. To put that into perspective, that's enough juice to power tens of thousands of homes.
And from that production, they generated a very solid $19.9 million in revenue, specifically from energy sales. Finally, wrapping up the rapid-fire numbers, their adjusted EBITDA came in at $13.7 million for the quarter.
Now hold on, let's slow down for just a second. That 199,130 megawatt hours of production, it actually represents an 8% decrease compared to the exact same quarter last year in 2025, back when they hit nearly 216,000 megawatt hours. Now on paper, an 8% year-over-year drop might make an investor a little nervous, right? But to understand the operational reality here, we really have to look closely at exactly why this happened.
So the primary cause for this dip was actually entirely expected by management. Why? Well, because last year they experienced exceptionally strong, record-breaking water availability, what the industry calls hydrology, at their hydro plants in Peru and Ecuador. Basically, Mother Nature was just in a really generous mood last year. This year, water levels simply returned to normal. Combine that natural normalization with some ongoing, though definitely improving, grid curtailment issues down in the Dominican Republic, and boom, there's your 8%.
So what you ultimately have is a quarter that is perfectly consistent with management's expectations. And you know what this beautifully illustrates is the absolute power of a diversified portfolio. While they had lower production from their hydro and geothermal assets and a few wind drop-offs in Puerto Rico, their solar plants in Panama actually delivered higher production. It's like a giant puzzle. The geographic and technological diversity totally mitigated the localized issues, turning what could have been a real problem into a perfectly stable, anticipated performance.
And that brings us to what I like to call the contextual pivot. Polaris' CEO, Mark Murnaghan, acknowledged the resilient operating performance, but then he immediately pointed to the real story here. He said, "We continued to generate strong cash flows and make meaningful progress on our strategic growth initiatives." See what he did there? He's actively pivoting our attention away from the rearview mirror of Q2 production and pointing us directly toward a massive, massive expansion. Now, what's really interesting about this is the sheer scale of what Polaris was doing behind the scenes during Q2. While the legacy plants were just humming along at expected levels, management was out signing 2 monumental, long-term development deals in June and July of 2026. Deals that will completely transform the footprint of this company. Let's look at Puerto Rico first.
On June 5th, Polaris executed an agreement with the Puerto Rico Electric Power Authority for a massive 71.4 megawatt battery energy storage system, or BESS, right at their existing Punta Lima wind farm site. This is all part of Puerto Rico's Accelerated Storage Addition program to help stabilize their grid. Polaris is going to install, operate, and maintain this system. But the most absolutely crucial detail? The 20-year term. For 2 full decades, they are locked in to receive fixed and performance-based monthly payments. Sure, it's an estimated $70 to $75 million capital expenditure, but man, it is a massive long-term revenue catalyst.
And the financial structuring of this Puerto Rico deal, it is incredibly clever. Polaris wholly expects this project to qualify for U.S. investment tax credits. If realized and monetized, these credits could offset a massive 30 to 40% of the eligible project costs. We are literally talking about an estimated benefit of $20 to $25 million in savings right off the top of that capex. I mean, that is just incredibly efficient capital allocation.
So we have this highly subsidized 20-year locked-in grid support deal in Puerto Rico. Honestly, that alone would be a huge quarter for most development teams.
But let's build on this, because if you compare that 20-year timeline to what they just finalized on July 3rd, actually, scratch that, it doesn't compare, it completely dwarfs it. Let's move over to Mexico.
Down in Mexico, Polaris executed a mixed investment agreement with the Federal Electricity Commission for 3 major renewable energy projects. And the size of this expansion is just staggering. They're adding approximately 250 megawatts of solar generation capacity right alongside an enormous 61.6 megawatt, 192 megawatt hour battery storage system. The estimated capital expenditure for this whole mega expansion, $240 million US. This isn't just a simple addition to their portfolio. This is a massive, game-changing leap forward.
So the crucial point is this number right here, 30 years. The framework agreement governing the development, financing, and operation of these 3 Mexican projects spans 3 decades. When you combine Puerto Rico and Mexico, Polaris has just secured decades of contracted financial security and growth. It's just a staggering level of long-term visibility for their future cash flows.
Now, naturally, you might be wondering, how on earth does a company fund over $310 million in combined expansions? Well, the answer is they're doing it from a position of profound financial strength. For the first 6 months of the year, they generated $15 million in net cash flow from operating activities, and they exited Q2 with a total cash position of $98.8 million. Basically, they have the war chest required to advance these exact types of massive utility-scale opportunities.
And what's truly remarkable, and really a testament to their disciplined financial management, is that despite allocating so much capital toward these massive future growth initiatives, they aren't abandoning their current shareholders. No way. Polaris declared they're going to maintain their quarterly dividend of 15 cents per share, payable this August. So they are successfully funding their future while still returning value today.
Which brings us to our final thought for this explainer. We started this session looking at an 8% drop in quarterly production, right? Caused mostly by weather just returning to normal. But by shifting our context, we see what management is really doing behind the scenes. With multi-million-dollar, multi-decade storage and solar pipelines now completely secured in Puerto Rico and Mexico, is Polaris the sleeper hit of the energy transition? I mean, they've taken a quarter of expected, resilient operations and literally used it as a launchpad to fundamentally rewrite the size and scope of their future. It's a masterful strategic pivot, for sure, and one that makes this company absolutely fascinating to watch. Thanks for joining me today, and as always, keep learning.